Hello, everybody. So today I want to talk a little bit about the GM nonsense. You may have seen this morning in the market. GM's up 10%, more than 10% actually, because they're making some moves, some moves that traditional finance, short-term thinking finance view as a good thing. And what are those short-term moves? Well, $10 billion buyback, because they are leading in the electric vehicle race. They are leaders in the transportations of the future, so they can afford to do a $10 billion buyback. I will point out that Musk has said multiple times that Tesla can't do that yet, that they need to have $26 billion of cash on the balance sheet, but not GM. GM doesn't need that. GM can do a buyback. Oh, and GM can pay a dividend, and they can get a dividend hike, a 33% dividend hike. That's right. GM is also a dividend stock. And by the way, GM is so rich that the union deal we know now is expected to increase cost per vehicle by $575. So they are affording to drop their profit per vehicles by quite a bit. And of course, whenever Tesla has even a hint of a price cut and the profits go down, the market freaks out. But for GM, that's okay, right? For GM, that's entirely okay. And as Marcelo says right here, they've just dropped their profit per vehicle by 30% just because of that $575 cost increase due to the unions. And GM has also made some long-term moves, long-term accomplishments. So what is the long-term move of GM? Well, first of all, the cruise scandals. There's been multiple ones if you'd followed all of that saga, but cruise is essentially gone right now. So they've essentially exited self-driving, even though they don't say it. They've essentially exited that. Actually, cruise was the only positive thing that a lot of growth-oriented investors were saying about GM. Well, now that's gone. You may remember ARK Invest's Kathy Wood being optimistic, perhaps even surprised when she was talking about cruise and how they were operating robotaxis. Well, now that's gone. Now that has failed. So that's them giving up the long term here, and that may have been not doing very well from very early on, and there was a lot of things that were hidden per what I read on the news. But that's not it. They've also made other long-term moves, such as welcoming unions to their EV battery plants, and that's estimated to be an added cost of $3 per kilowatt hour. So what that means is that they are pre-booking a $400 cost disadvantage on the battery alone before they even launch EVs to the mass market. Before they do an even mass market launch of EVs, they're already committing to a $400 cost extra, right? Extra cost. They're already doing that because they don't have a problem bringing unions and adding $3 a kilowatt hour because EVs are expensive or something. I don't know, because we're facing a company, Tesla, who keeps dropping prices. Oh, by the way, also, what has they done? They've decided to save $1.5 billion by punting production to 2025. So as soon as they noticed that their EVs maybe don't sell because of interest rates, they have moved the production to 2025, and they've also removed their plans to develop a vehicle, an EV of less than $30,000, even though that we know that Tesla is racing on with their $25,000 EV. This is a company that I have a hard time imagining how they're going to sell anything in 2025 or 2026. Or at least if they sell something, that's because we can't supply enough EVs. And that's pretty scary. But the stock is up because Mr. Market loves the long run, right? These decisions for 25, 26 are awful decisions. But for the short term, the market is all about the short term. So right now, up 10.8%. Amazing. This is financial engineering at its finest. The shareholder base of GM must be sleeping. This is a stock that's mostly held by institutions, mostly held through index funds, I would argue. And this is another, and this is more of a philosophical question, but what is, and I've said that before in other videos, what is the business of GM? Is GM in the bailout business? Is that their business? Is the business not making a compelling product that you're going to sell 3 years from now? But is the business it may very well be that their business is receiving tax incentives, and they are very good at that. They received, for example, a $3.5 billion tax incentive for their battery plant in Indiana. Now remember, money is fungible, right? If the government finances $3.5 billion, gives you a $3.5 billion incentive for a battery plant that you're going to build somewhere, it's money that you don't have to come up with and that you can then invest in dividends and in buybacks, right? So money is fungible. So that's part of the business, getting the money from the government. Another one is if you look at the Chapter 11 that GM went through in 2008 during the crisis, that cost the taxpayer between 11 and 12 billion if you add, for example, Ally and GMAC, but 10.5 billion for General Motors. And I think it's kind of funny, hilarious that the amount of their bailout they decide to just put it in buybacks, and buybacks are money destruction, right? You're reducing the number of shares, you're destroying that money to reduce the number of shares. But if you don't make sure that the business is a quote unquote lean and mean business, if you don't make sure that the business has a product for the future, then the present value of future cash flow is null, because future cash flows in 2030, what are they going to be if you don't have a compelling vehicle, right? Well, maybe the future cash flows are not going to come from selling the products. Maybe the future cash flows are going to come from getting more bailouts. And the more I look at this, the more this is the way I see a business like GM. The business is to position yourself such that the government gives you incentives, in my view. And what's very funny is, for example, you may say, oh, well, there's the IRA. Well, the IRA, I've called many times a terrible deal for taxpayers. Elon Musk is on the record calling the IRAs and the incentives not helpful. And he said multiple times that EVs would happen without them. Right, but that's just because a lot of these companies that are forward, future-looking, widely claim that they don't need incentives. This is not the case for legacy business, who actually need incentives. And in fact, Mary Barra, they need help. She's been seen, with the President of the United States playing that game of incentive. Another executive that is very good at playing the game of incentive is my second position, Enphase. Right? I obviously own Enphase because of the technology, because I believe in the underlying technology, but there's no denying that Badri, the CEO of Enphase, is very good at understanding how this incentive game works. And he was also seen making a speech next to the US president at a plant that they were just opening. So there is this side of the business that, most companies in the transportation, like vehicle car space, and most companies in the renewable energy space have both sides of that business. But there's companies that have winning products in addition to the incentives, and you have companies who have losing products and who also get the incentives because they are close to the unions and because they need to focus on that energy transition. And really, these short-term moves, all it does, it precipitates the decline. It precipitates this long-term decline. Unions, buybacks, dividends precipitate the long-term decline. And if you precipitate that decline, you may get a bailout sooner. And I will conclude this video on GM just by talking about the balance sheet a little bit. Most people think balance sheets are boring, but they're not that boring when you consider, for example, how a balance sheet like GM is built. So they have $30 billion of cash, so they're spending 30% of that on buybacks, probably another big chunk on the dividends and the dividend increase by 33%, a little bit of receivables, right? They're going to get that. Where it gets interesting is when you start looking at the current assets and the long-term assets. The current assets, $17.7 billion in inventory. And if you follow a lot of car channels, you know what is happening to the value of inventory. And 43 billion of leases. And then in long-term assets, you have 281 billion, including 50 billion of plant and equipment that makes that makes gas cars. These are plants that make gas cars, and $49 billion of leases. So if you add up all of the liabilities, you have, let's call it $300 billion in liabilities. The current equity for GM is $78 billion. But here's my main point. In my view, there's $160 billion in those assets that are at risk of being marked down. And we can easily understand, if these markdowns happen, how this is a company. If they keep lowering their profits, this is a company whose equity could really go down quite a bit and who could become, from an accounting standpoint, bankrupt, right? What if you erase half? But it could be more than half. But what if you erase half of that? You have a company that's essentially bankrupt, right? And the question is, what's going to be the value of this inventory, of those leases, and of these plants and equipment in the future? What's going to be the value, right? Is the value that we see right here even the current value, right? What's the value of plants that are scattered across multiple countries and across the USA? What's the value of those plants when they can only produce gas cars, or they can produce electric cars inefficiently because the way of manufacturing electric cars is the same as how you manufacture consumer electronics, which means you have a giant factory, right? How much capex are they going to have to put into those plants to update them? So what's the value of those plants, right? They may get into diseconomies of scale. These plants might actually become major liabilities and not assets. Then, what's the value of the inventory that is returned once the leases end? A lot of sellers of gas cars have been very cocky in the price that they offer to take the car back, right? When you lease a car, at the end of your lease, 3 years, 5 years, whatever that is, you have a value that you agree with the seller of a vehicle at what price they will buy the vehicle back from you. That's the value that they agree. My view is that for most of these vehicles, the price is going to be way too high, right? GM is going to say, we're taking back the inventory at a price that is going to be much higher than what they can hope to resell it in the used market. So what's going to be the markdown on the current inventory and all of the inventory that they get back from when the leases expire? And then the third question is, what happens when people walk away from their lease? And this happens all the time in the US, right? It's a common practice. Repossession, repos as they're called, and we know they are through the roof right now. But what happens? How does a repo work, right? How did it work in 08, 09? And 08, 09, these repossessions were driven by the economy. I believe we're going to see a wave of repossessions that are not driven by the economy, but that are simply driven by people walking away from their cars because they realize that they're underwater on the car. Why are they underwater on the car? Because electric vehicles have made gas cars entirely undesirable and nobody wants them, right? So what happens if you have someone with a $110,000 truck today, and if you buy a quote-unquote nicer truck, you may be even more than that, but if you buy, say, a nice truck, $110,000 today, and remember, the bread and butter for a company like GM are these big trucks. If you buy a truck for $110,000, what happens if it's worth $40,000 in 2026? And say you still owe $80,000 on it in 2026 or $70,000? You're just going to walk away. Many people are going to walk away, right? And this could trigger even more losses. So this company, to me, looks like a house of cards. And if I were managing this company, and if I were thinking long term, I can think of many things to do with those $10 billion that are about to be spent on the buyback. The number one would be investing in EVs. But then number two, if you're not going to be investing in EVs, work on your liabilities. Work on your debt. Reduce that debt. Because that's a bigger threat. But again, they are maybe not in the business that I think they are. This may be a company that is preparing itself and preparing its balance sheet and preparing the look of its business as an ideal candidate for another incentive, for another bailout. And we move into entirely different businesses. They've been successful at doing it once. They could be successful again. So anyways, more of a rant style video, but not investment advice. I appreciate you watching my channel. Thanks for liking. Thanks for subscribing, and have a wonderful day.